You're watching MPTV. Now, since the GFC, a lot of people have been looking into or indeed taking up self-managed super funds. There's a lot of regulations surrounding them. To talk more about them, from the REIV, Robert LaRocca, and from Empower Wealth, Ben Kingsley. All right, gentlemen, self-managed super funds, are they for the filthy rich or can anyone have one?
They're not for anyone, Des. Right. It is interesting. About 100 people a day are actually taking up self-managed super funds. If you refer to the ATO data, you're looking at 36,000 new self-managed super funds were set up in the last 12 months.
And it is basically, as it says, you manage your own super fund, but I guess to a lot, you'd have to know what you're doing, wouldn't you?
Look, the research tells us that it is all about people wanting to take more control. That's the number one reason why they're looking to set up self-managed super funds. So to come back to your original question, is it for the rich? It's not necessarily for the rich. I think it's more for people who are saying, you know what, I think I can actually have a go at this and I reckon I'll be doing all right or better than maybe the returns that I've been getting post-GFC.
I can see why you would. I've been looking at my super for the last 3 years and I put in 15,000 and I lose 5 for the year. So you wonder why the heck you're letting someone else do that.
Well, yes, I mean, it has to be for the astute, I think, not the rich.
Oh, not me.
Well, you know, you do have to know what you're doing because, you know, you are actually out there investing your retirement future, you know, and you're betting against, again, the super funds that they know what they're doing. Now, I think generally they probably do know what they're doing, but some people would like to actually pursue a certain investment strategy, investment class that the managed fund won't let them do. You know, we're obviously going to advocate that property is a part of that, and you know, a lot of self-managed super funds have a lot of property involved in them.
Okay, and how does it work with property? What are we doing if I want to set up my self-managed super fund? What am I doing? I've heard that you shouldn't really look into it unless you have around $200,000 in your super fund.
ASIC have come out and said that you want to make sure that around that sort of 200,000 is a loose benchmark. It's more to do around the fees. I mean, if you're looking at running a self-managed super fund, you're talking about fees, setup costs as much as $5,000 depending on which advisor you may be working with. You're also talking about ongoing costs and ongoing auditing. So I think the most important thing is if you were looking at an industry fund and they were, say, charging 2% in terms of operating that's what you've got to look at. And that's what ASIC are sort of saying. They're not sort of saying it needs to be $200,000. And coming back to the property question, I think a lot of people are going for the self-managed super fund because it's the only way in which you can get into direct property. Now, how it's set up is you actually put a property into a bare trust, and that basically is separate from the overall superannuation fund that you're holding. And the reason for that is there's no recourse against that particular lending if you're actually taking a loan to actually secure that particular property. So the ability to borrow money and control a larger asset is the reason why people are saying, well, I really like property and I usually take a loan associated with investing in property inside or even outside the super fund. Well, I can now do the same. And then so they're looking and saying, well, my income is taxed at 15 cents in the dollar coming into the fund. And in terms of any capital gain that I may have, if I sell the property prior to going into a pension phase, it's capital gains tax at 10% if I hold it for greater than 12 months. And then when I'm in pension phase, i.e. when I'm in retirement, the property is actually capital gains tax-free if you choose to sell it, and also any of the income being generated from that property is actually tax-free at the moment.
So if I have $200,000 in my own super, can I buy a $500,000 property and borrow $300,000? I always thought you could only buy to the equivalent of what you had in your super fund.
No, what basically happens is there's still borrowing assessments that need to be undertaken, and those borrowing assessments include the rental income as well as what contributions are being made into the fund. So the banks still have their calculators in working out what sort of serviceability. And one of the interesting things about super is you can't borrow more than 80%. So some lenders have policies at 70% loan to value ratio and other lenders have 80% loan-to-value ratios. But it still comes back to the actual fund, the people who are setting up the funds. If someone's 55 or 60 years of age and they're looking to invest in direct property and they're looking to take a big loan against that property, you've got to think to yourself, there's a shortfall in the commitments that are going to be made there. So all of the money that I'm actually getting in pension phase is going to service the loan. So it's a crazy idea. So what I worry about in any type of investing is to make sure the fundamentals stack up. So if you've got a long time to go in your super and you're in that accumulation phase, then certainly make sure the type of asset that you're selecting and the type of property you're selecting is appropriate for you, versus if you're in that older stage, you don't want to be risking your whole super strategy around trying to get some big gearing play on a $500,000 residential property. It's just not right.
The same metrics apply in just the basic investing in residential property. You know, you're not going to make a lot of money in the short term with it. I can see why people do pursue that as an option, though. I mean, the figures show that investment in residential property is a good bet. You know, over the long term, it's done slightly better than the stock market, and you know, you get your returns every year, and your super fund's been losing money. You don't have the variability in residential property. You know, you may not get some of the large gains that you see on the stock market, but then again, you know, it's about your future, and you want to have some security there. So, including property in there is a good avenue to giving yourself a good, decent long-term future. But you know, I don't think you want to get into it when you're 55. To start with, no.
And also, it obviously isn't just property; it's shares as well.
Definitely. I mean, in terms of shares, yes, you can have a balanced portfolio. It comes down to the way in which you structure your trust deed and the investment strategy inside that trust deed. So make sure when you are setting it up that the actual self-managed super fund does accommodate direct residential property. A lot of people very early on in the piece set up trusts and super funds. Now, if you make mistakes like that, you're responsible for it. You know, you can't outsource the responsibility when you're looking at a self-managed super fund. And I think that's a message for all the viewers.
But people use advisors to set up their self-managed super fund. So,
well, accountants can set up self-managed super funds. Certainly, advisors, financial advisors that are, and you're now seeing people in the property space also advocating, you know, certain properties as good investments inside their self-managed super fund. Now, I'd question anyone who's looking to invest in property to do your research. You are only buying one at a time, and that first one needs to perform.
Be a good one.
Yeah.
And ultimately, the more you go down that path of getting extra advisors, further professional advice, it's got to, you know, add up cost-wise to a certain point where it might just be better being part of just your super fund, really.
People are disillusioned, do you think? Is the GFC responsible for a lot of people just thinking there's got to be a better way?
I think there's no doubt that, you know, with uncertainty in the markets and certainly no one talking up the markets, that the people are starting to look for alternatives. And I do think that self-managed super funds are a very good alternative for the right person who's committed to the time, exercise involved, and certainly building up their knowledge to understand exactly what their requirements are if they're setting up a self-managed super fund.
It can be a great hobby if you've got the time and you've got the interest in the financial products.
And setting up your financial future.
Well, that's right.
Thanks, gentlemen, for explaining self-managed super funds for us. If you'd like to know more about self-managed super funds, go to our website after the show, mptv.com.au, and Ben will be in the chat room to give you some more advice.
This show is brought to you by the Real Estate Institute of Victoria and realestateview.com.au.